Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome back to the Dentist Money Show, where we help dentists make smart financial decisions. I am Matt, and I'm here with the one and only Hot Take Jake. Jake, how are you?
What's up? I'm doing great.
Yeah?
Life's great.
Good.
Excited to be here.
You having any hangovers from our retreat last week?
No. Had a great weekend. This past weekend, I don't know if listeners care about this, but it was our secondary water finally turned on for sprinklers and getting the yard ready. I did sprinklers and lawn stuff this whole past weekend, which I find energizing and refreshing to do.
I love it. If I could, I'm going to have an encore career at some point, as they say. And it will be something to do with landscaping. I've literally thought at one point doing landscape design in my retired years. So not for a while, but I love working in the yard. It's my favorite.
Got the sprinklers all rounded up. I went to Lowe's, I think 3 different times for different sprinkler heads and whatnot, getting everything ready.
The best.
That was my last weekend. It was great.
Yeah. There's certain I know there's certain places people can't go, like whether it be, I can't, like just shopping in general. Like I need to take the Amazon app off my phone or whatever. For me, it's like I can't go anywhere with plants. I was at Costco this weekend and they've got all their plants out and I'm like, this is a problem. This is an issue. I love it so much. So I'm with you. I think a lot of people are. Okay, well, speaking of plants and speaking of yards, I'm making this leap here, Jake, to a really important topic, one that questions around this, we get so much. You're mentioning 3 client questions about this exact topic, which is how much house can I afford? So you got to buy the house before you can put the plants in and the yard in and take care of the yard. So we want to talk today, how much house can you afford? Let's just kind of like, what are your thoughts on this, Jake?
Yeah.
Give us your intro.
Well, I brought this to you, Matt. Again, over this past weekend, I had a couple of emails and questions about just housing stuff. And it just got me thinking, I think, and I want to hear, Matt, if you disagree with this, but I think questions around homes or houses or like renting versus buying or remodeling or upgrading a house or downsizing, just like housing questions in general.
Downsizing. It's funny.
I know. We can talk about that if we want to. I think housing questions are the number one type of question that I get. Like, I think I have more housing questions than any other financial questions. I think I'm willing to go out on a limb. I think that's true.
Yeah.
Do you see the same thing?
Yes. I would say it's got to be number 1 or top 3 for sure.
Easily top 3.
Yeah, easily top 3. And especially as you broaden it out to buying a new home, remodeling a new home, building a new home, any of those things. It's easily top 3.
Yeah.
For sure. And number 1 most emotional of all of the financial decisions we make.
That's what I wanted to talk about too, is houses. I do get a little nervous, I think, Matt, talking about homes because people have such strong opinions about homes. And especially now, again, we talk about this on our other podcast on 2 Cents. I think, the housing market over the past handful of years, really since COVID, it's been pretty nuts and pretty crazy. We're still in a place where housing is pretty unaffordable.
Yeah.
And I think, and we've talked about this, that our economy as a whole is doing pretty well.
Yeah.
Right. Like the stock market as well. Like unemployment is really low. People are still traveling and spending and it keeps churning along. But there's this one big, like massive, like the housing market thing has people up in arms. And I think that people really care about that more than any other thing. Like I think a lot of the discomfort or people's complaining or anxiety about the economy as a whole comes down to, well, houses are really expensive and I wish I could move, or I wish my kids could buy a house, or whatever that may be. And because the housing market is a bit broken, they just can't see that everything else is going well. And I just think all of that is to say, houses are really important to people, like really, really important. And that's why I just wanted to talk about it today. I don't think we've talked about it in a while. And so I'm stoked to dive into a few different things here with you.
It's the cornerstone of the proverbial American dream, right?
Mm-hmm.
So to your point, I think no matter, like, it is the most important data point for the general consumer.
Yeah, I think so.
Yeah. I think
which
it
is
is.
wild.
If housing's too expensive as it is, I know you've got some numbers here to back that
Yeah,
up.
we can talk about
This
it.
is not a myth. Like this is not like this. The data doesn't match the narrative thing. This does match, and I think it has a ripple effect on the psyche of Americans across the board for
Yeah,
sure.
so let's go through a few of these. I just brought a few stats that we can talk through here. There was a Harvard study done. Like we can start with just the inaffordability or the expensiveness of homes currently, which is the monthly income. Harvard did a study just in 2024, so we're a couple of years out of date here, but we kind of get some of this data backlogs to us. So this is kind of the best that we have. That the annual income needed to afford a median priced home, right? So like just the average home in America, you would need to make $126,000 in 2024 is kind of like recommended income for the median priced home. That's a 60% increase since 2021, which is wild. 60% increase is insane over a handful of years. And then like we can compare that with what the actual median household income is in the US, which hovers around $80,000 or so. Again, we're talking households, so this sometimes can be made up of two incomes in a household.
Yeah.
But median is about 80,000. So there's a big discrepancy between median 80,000. You need about 126,000 to afford the median home. There's a pretty large discrepancy there, and a lot of people are getting priced out kind of general houses currently.
And I believe we don't have this in front of us, but the median home price in America now is like 400,
Yeah, we can do a
420.
quick Google. That sounds right, Matt. Yeah, 400.
Okay.
Around there. Yeah.
So now we're saying 126,000 to afford about a $400,000 home. The 60% increase is just wild.
60%.
Yeah.
And that's, again, house prices went up also with interest rates went up right over that time. We all know the story if you've even peripherally following the house market. And that's just how that goes. And so
I think that's a huge factor here, really quick. I think that's a huge factor is whenever we talk about any type of data that works against us, right? So inflation or prices of homes, whatever, the price of eggs. Whenever we talk about specifically inflation or raising prices, the speed in which it increases matters.
Oh, yeah.
Like that, this is why this has become such a problem for people. And not only has the housing market, like to your point, not only has the price increased over homes, but I think in lockstep because of rates, to your point, that's where it's gone 60%, right? If rates would have stayed normal, this would have not been nearly as big of a problem.
Yep, it's a combination of the two. And yes, the speed affects that. I think about this with inflation too, right, which we talk about often. For most of the 2010s, we did not get huge inflation numbers. We had some really low inflation years. And so I think about this, we kind of had a decade of hardly any inflation and people got used to that. And then we sped everything up and we recouped all of that other inflation from COVID on. And I think that was just painful for a lot of people. Same thing with houses. Again, I've gone through a ton of housing stats. I think there was another one where like we've already seen like for a typical decade, most houses appreciate at a certain price. And we've seen that price appreciation already from like 2020 to 2023 was like a full decade's worth of house appreciation in just 3 years. And so, yeah, we're living in abnormal housing market times, I think.
Well, and it matters what this is why we say the speed matters, because it matters because we had such a long period of time with such low rates, right? Try telling somebody that, hey, this is actually where we're at right now with rates is pretty normal historically. It's true. It's also not useful because try telling someone looking for a house right now, hey, don't worry about it. It's actually pretty historically accurate, pretty historically normal and average to have somewhere in the high fives, low sixes for that is a totally normal rate.
Yeah.
That doesn't matter because our reference group and what we're comparing it to and what we're anchored to is 3% rates for over a decade. So that's where, and because it moved so quickly, it doubled so quickly. Yeah. And because we still have such a shortage of homes, it doesn't matter. It still is so painful and no one cares about what the historical rate is.
Yeah.
So, and I guess we're saying is we understand. We understand why it's so painful.
Yes, I am 100%. If you want to complain about the housing market, go for it. I won't stop you. I get it. And I'm talking particularly for the new home buyer. Yes. Right? Like you can make an argument that for people who owned homes before 2019, 2020, you've been able to build up a lot of home equity over these past handful of years, and you probably have like a 3 or 4% rate as well, right? These higher rates have not affected you. And so your payment has stayed low and you built up a ton of equity. You're kind of in a good spot, right? If you've been a homeowner from 8-10 years ago, you're probably doing okay. It's for the people looking to buy a home right now who do not have any home equity built up. And you could say, and we'll talk about home equity and how important and things it is. But if you're an existing home buyer and you're looking to buy a house, you're like, dang, things are really expensive. This is a big jump in monthly payment. I get that. But you have had the past handful of years to build up some equity that you can roll over to this new home and hopefully lower your payment. So if you've been in a house before the past couple of years, I think you're doing okay, or you feel okay about it. It really is these millennials, first-time home buyers that are really struggling. Like, how do I break into this
Yeah.
space? So,
Well, and could you say, I mean, I don't know this for sure, but I think it's not unreasonable to say that we went from the best time to purchase a home as a first-time home buyer to the worst in a matter of a decade.
yeah, I mean, 2012 to 2014 is probably one of the
Yeah.
best times. Honestly, looking at historical data, one of the best times in the history of America,
To buy a
honestly,
home.
to buy a
Yeah.
home because of
Yep.
where rates were at and because like deflated house prices from the '08 crash and '09 crash. It was an incredible time. And we've seen the past decade bigger housing gains than we've ever seen in any decade before. So yes, we went from like 2012 to 14, like a once in a lifetime buying opportunity, to now things are pretty dang expensive
Yeah.
and tough to get
Yeah.
into.
It's interesting. And
Yeah.
then you had some numbers comparing this to kind of giving more context here of comparing this to the stock market.
Yes, where this is why housing, I think, is so important for most people. For pretty much everyone in America, your house is your biggest asset, right? For non-business owners or things, there are people who save a lot of money in the stock market. Housing is really important. Traditionally, people want to buy a home because it's part of the American dream, and that's how you build up really some equity and some wealth. And so like the stock market and the housing market are quite different in this sense, where the top 10% of households by income in America own 90% of all stocks. We
Yep.
can repeat that. 10%, the highest 10% income cohort owns pretty much everything, 90% of all stocks. But with housing, that amount is far less concentrated. The other 90%, the bottom 90% of, I'm saying this. I guess how I want to say this is, so 90% own the top 10% of stocks. So that means the rest of 90% of the population in America only owns 10%
Yep.
of stocks, right? And kind of how those numbers work. It's different with housing, where the bottom 90% of income cohorts in America own 60% of the housing market.
Yep. Yep.
So
You're saying it's the stock market is very concentrated with the people who hold most of the wealth.
Yes.
And let's be honest, this
Yes.
is skewed because the baby boomers have so much money.
yes,
They've accumulated so much wealth over the last 40, 50 years, which makes sense. The oldest generation right now that's still, living is baby boomer. But you're saying, and in the housing market, it's really the asset class of the people. It's
yes, everyone owns a
90%.
house.
A lot of people own houses.
65%, I think, of adults is what
Yeah.
the recent number was, own a house, where it's like closer to 50%
Yep.
of people who own stocks in a 401k or anything there. But yeah, so it is the house, and house equity really is the asset that most people can hang on to. It's really the only asset we've talked about, this of like building wealth through a home, where we don't think it should be your primary wealth builder. We can
Yeah.
get into that more. But it's really the only thing that people would just like put on a mortgage and put $2,000 a month into for 15, 20 years. Helps them build wealth there. So yeah, all of that is, homes are very important. to
Well, and
people.
to circle back to what we said at the very beginning, those numbers right there show why there can be like the general population, when the stock market, we see it, live and breathe it every single day. We're talking to Rob about it every week. We're like, wait, the stock market's crushing right now. Why are people still bothered? Or why are people still kind of discontent with what's happening? It's the numbers you just highlighted there are exactly why. Because housing has changed so much and become so unattainable for so many people, especially the younger generations now. They don't care what's happening with the stock market. There's probably never been a bigger disjointment
Yeah.
of what's happening in the stock market versus what's happening in Wall Street versus what's happening on Main Street.
Yeah, somebody who has $5,000 in a work 401k isn't really concerned, in like a target date fund,
Yep.
is not concerned about what the stock market's doing. They're far more concerned about, man, I kind of want to buy a house because we just had a new kid and we have a third baby and we have to increase this. And so they're like, this is untenable, right?
Yeah.
Type of thing there. So,
Yeah. Yeah. So I think we hopefully did an ample job of highlighting the problem here and giving some, and truly trying to show some empathy of, we totally get this. This is a legitimate problem. And there's a reason why we're getting all these questions. Let's just highlight really quick, though. The data we're just talking about is the general population, which we only work dentists. Dentists are different in a lot of ways. One of the main reasons they're different, that's obvious, is they make a lot more money than the household or the average household in America. on average 4 to 5 times the average household in America. And so that makes the problems, there's still problems because we still have a massive shortage of homes, but it almost makes the problems bigger because now we're dealing with bigger numbers because you make more money, the bank's going to approve you for more money, for a bigger loan. You're out there searching for bigger homes. Consequences are higher. But we just want to highlight, like, it's still a problem in dental space. It almost could be even a bigger problem with bigger consequences because we're dealing with bigger amounts of money.
Yep. And so we gave the kind of what's happening in the housing market. I think we want to transition more into some concrete advice for people
Yep.
who are like, okay, I understand the housing market situation. It is what it is. But how do I go about framing how much house can I afford? Like, what should my
Some
price range
guidelines.
be? What can I look at? So we wanted to give you just some key principles and things to follow. Do you just wanted to dive in, Matt? Start with the first one here.
So I think that exactly your point. General principles here. We highlight this saying, as our boy Taylor Sutterfield says, general advice is not really great specific advice. But I think this gives some good direction for people out there listening. If you're not a client of ours, to at least give you kind of a narrower focus of financially, what should I be thinking about if I'm out there hunting for a home?
Okay. So the first place I would start is I don't really like to look at homes like from the just sticker price of the house, whether it's 500,000, 800,000, whatever. I like to frame things. Most of us are getting a loan for a home. And so frame that as part of like how much house you can afford is how much like of a monthly payment can you afford. So I would say to try to keep your monthly mortgage payment at 25% or less of your gross income. We can get into some of the nuances and details behind this. If you read a personal finance textbook, it'll tell you to keep your housing costs at 28%, I think is still the gold standard that you'll learn in school if you went to school to study these things, about 28% or less. I like to do 25 or less, kind of again, gearing this more towards dentists, the clients that we work with. A primary reason for this being is you have a lot of other debt outside of your home. For most dentists, when you're buying a home, you will have student loans that we have to factor in. You'll have a practice loan, maybe a practice building loan, all of these other debts that will pile up. And so we can't be too aggressive, I don't think, on the housing front, at least early on in your career. Again, if we're saying our overall debt to income, ratio, Matt, that we like to use, all debts included, is we generally don't like to see that above 40% of your gross income, right? Ideally.
Not for extended periods of time, for
That's
sure.
when, if there's any stoppage of income or things, you're getting sticky situation with the debt payments you owe. So if we're saying 25% of it is the least towards the house, that only leaves another 15% for student loans, just loan, car loans, any other type of things that you may have there.
Yeah. And by the way, we're saying, just to highlight, or just to make sure we're clarifying, we're saying housing costs, right?
Yeah.
And we're not saying just your principal and interest. If you were to run some back of the napkin math, we're talking about actual house, like your total housing costs, including your
insurance and taxes.
Insurance and taxes. What is your total housing costs every single month? And you have to factor in like maintenance.
Yes, which that's one I think people forget about sometimes. Insurance and taxes are quite a bit, and they will add up on you there, particularly if you live in certain areas, Florida, California, New York, right? Property taxes, even in Texas, right? They don't do any state taxes, but they'll get you on property taxes.
Oh, property taxes are wild there,
So like, for example, if you make $100,000 a year, right, we would recommend about $25,000 is a comfortable amount to go towards housing, which comes out to about like $22,000 a month, $2,083 a month.
Yeah, if we're giving like a dental specific example, let's say you're making $30,000 a month before taxes, so about $360,000 a year.
Mm-hmm.
That's $7,500 a month for all-in housing costs.
Yes, which sometimes, now I've had this conversation before with clients where their income is quite high early in their career, but because of, again, like we talked about, student loans or practice loans or other things that they're paying off or working towards, that 25% rule of thumb is actually higher than they can fit in their cash flow budget, right? If that makes sense, where it's like, hey, I'm making $500,000 a year. Gross income is my top line number, but I have a big practice loan and student loans and different things. I only have like $4,000 extra in the budget.
Yep.
Right. I can't jump up and even though that 25% is our rule of thumb, we're really going to have to move some other things around to fit in that big of a house payment. So this is where context matters too, where 25% is a good starting point, but we also have to make sure that this fits within your current budget of savings and other debts and spending that you have going on.
Well, this is exactly what we're saying. This is a rule of thumb. This is general advice. ChatGPT is going to tell you one thing. By the way, a bank's going to go way higher than this.
Good note.
Way higher. A bank's going to go up to 42% debt to income ratio if they were to if you were to go get like a pre-approval letter from a bank, they'll go up to 42. So, and again, this is where emotions come into play because all of a sudden you get a pre-approval letter. I've talked to Dennis about this before where they're like, holy cow, I just got approved for $3 million.
Mm-hmm.
Right. And then it's that all of a sudden becomes like this, well, what could we get for $3 million? So to your point, Jay, you got to keep context there because even though 25% is our rule of thumb, the CFP, which you might find through like a chat GPT or something like that would tell you 28, and then a bank will go to 42. You got to factor in your actual detailed cash flow for your unique situation.
I would honestly prefer closer to 20% for a lot of my clients, if I'm being honest. I think is a lot more comfortable. A few more context things here of, adding on to this rule of thumb. It is entirely possible where you could be starting out your career, you want to get into a home, you're buying a practice, where you want to stay long term. And you could say, well, this is my income right now, but I expect my income to go up over the next 5 to 6 years. I really do expect it to grow. I'm going to build this practice. I'm going to work harder, etc. I think there's wiggle room where it's like, well, this house is 30% or 33% of my income currently each month. But I really I'm fine buying it because I expect my income to go up. I really do. Now, that's, again, a dangerous game to play for some people. You have to make sure that we're being smart about things there. But I think that's a valid point in opinion where it's like, I just want to get into this house right now. It's going to be a bit of a pinch currently, but here's X, Y, and Z things I'm going to do to increase my income. And in a couple of years, this payment's going to be a healthy percentage for me.
Yeah.
Right?
And I'm okay with that in some cases, like you pushing yourself a little bit more, depending on your situation, depending on your career goals, your family situation, income, obviously. And so, yeah, I think there's some validity to that, but I think that taken too far can, especially when you mix in that concoction of emotions, it's easy to justify. And it's really, really easy to be disciplined in the future. So we hear a lot of like, yeah, this will, my cash flow will be tight, but like, I'll be fine. Like 6 months from now, I'll cut this or that or the whatever. You start to rationalize it. So just be careful with that mindset.
I agree. It's also likely that other spending will go up too when you buy a house, where it's like, again, we talked about
the Diderot effect.
Trees. Yeah, there's trees you need to plant and bushes, and I want to paint this or do that. And
you get pumped. I get it. You get pumped. You want to go to Home Depot and Costco and do all these things. And all of a sudden you're like, you buy this house. Oh, that bathroom's not great. We'll give it, but we'll remodel it in a couple of years. And then you're in it for 6 months and you're like, let's remodel it now. Yep. So the Diderot effect is real for sure. What about down payments, Jake?
Yeah. So let's just move on to our second principle here, which is do not use all of your cash for a down payment on a home. In general, again, we recommend keeping a 3 to 6 month healthy, 3 to 6 months of personal expenses as an emergency fund. I would be hesitant to dip into all of that to get into a home. Again, it's just one of those things where that emergency fund is there for emergencies and a buffer against whatever life is going to throw at you. And if you have to exhaust all of that to get into a home, you're just exposing yourself to some risk until it takes you to build that money back, right? Type of thing there. I do like talking. I did want to use this opportunity to talk about down payments and their impact, because I think this is a good point I talk about with a lot of people is a down payment doesn't go maybe as far as you might think with a 30-year mortgage. I think about this often. So right now with where rates are at, I'm hovering around 6%, with a 6% rate on a 30-year mortgage, $100,000 down on your house saves you about $600 on your monthly payment. $100,000 is a pretty big chunk of change. To put down. I think people expect it to do more, where it's like, okay, there's an expensive house, but with my equity and I'm going to put some money together and put it down and I'm really going to lower your payment. It doesn't lower it as much as you think. Again, $100,000 for $600 extra a month in free cash flow. But that's working with dentists who are generally high income earners. I would, in most cases, would way prefer to keep $100,000 in your pocket or in your investment account than just pay the extra $600 a month. That's a lot of months of $600 before you're breaking even on that $800,000 you put into your home. And so I think our general recommendation, Matt, for our clients, because they're high income earners, is you don't need a huge down payment in most cases. I know the Dave Ramsey 20%, people will tell you, I don't think that's feasible in a lot of situations. And I think your money is best used elsewhere, whether it's keeping your emergency fund on hand or keeping that money in an investment account growing at a higher rate than putting it towards your house.
Yeah. I tend to agree with this, generally speaking, that you don't have to put too much pressure on yourself. I know the kind of rule of thumb is like, you need 20% down. First of all,
no one does.
Dentists specifically do not, even more so than the general population. a lot of times you can actually get it where you're not paying. I know this whole thing about PMI is a big deal for
People
people.
freak out about it.
People
Yeah.
forget about PMI. I've owned a couple of homes in my life, and I've paid PMI on a couple of homes in my life. Like, it's not a huge deal, and we're not like, again, general advice, general advice.
Mhm.
But I do agree with you that people feel like it is like only way I can buy this home is if I put 20% down, and I just think that is not always the case. To your point, this example, 100K. Would you rather have that invested elsewhere or have that just in liquidity, or scrimp and save and put every last dime you have, and then the home's purchased, and then you look at your bank account and you got no money? That is the definition of house poor,
Yep.
and your stress levels will be so much higher, rather than, to your point here, this example of like, yeah, I'm paying an extra $500-600 a month, but I have that 100K in the bank. Big difference.
Exactly. And generally speaking, we do not consider homes to be an investment, right?
Then
Where it's an
lifestyle
asset
investment. Yeah.
on your balance sheet. You can pass on to your kids when you pass away. But in most cases, you are not selling your home to fund financial goals, right? You always have to have somewhere to live. So, but if you did want to view your house as an investment, if we're just like talking math and numbers here, the less you put down, the bigger the return you're getting on your home. Because when you get a home, even with a loan on it, you get 100% of the appreciation.
Yeah.
Right. So let's say you bought a $500,000 home and you put $100,000 down, and let's say it grew, the value went from 500 to 600,000. You had a 2x return technically on your investment that you put in.
It's
I
called
put
a
in
cash on
100,000.
cash return.
Yeah, cash on cash. I got 100,000. If you put $10,000 down for that same home, you still get the $100,000 worth of appreciation. That is a 10x
Yep.
cash on cash return. It's actually smarter to use the bank's money to get a bigger asset. You're actually leveraging your return. Again, we usually don't view houses.
Are we becoming real estate guys right now and
as
live?
an investment, but like you're getting all of the appreciation no matter what. I think my philosophy would be like, I would actually want to put as little money down as makes sense for my budget. Kind
Yep.
of is my general stance.
I think that's
Anyway,
I think that's totally right. And can we double down on this really quick, of this idea of a financial asset versus a lifestyle asset?
Yeah.
Because how many times, Jake, do you have a client or dentist you talk to that tries to justify a lifestyle upgrade in their life, like a home, with financial justification, or like balance sheet justification, we'll call it? How many times does that happen? So, for example, I'll give you an example. Someone says, yeah, we're pushing it here, or we're not totally ready maybe for this, that, or the other, but this area, like, it's only going up, and we can totally sell this in 5 years for a return if we needed to. How many times have you heard some version of that? Someone justifying
Yeah.
a lifestyle purchase?
more than I can count. What about
Yeah.
the pools in the backyard too, right?
Yeah.
It's always the house upgrades and the remodels where
Yep.
we're going to put a pool in there, but hey, the pool costs $100,000, but it's increasing the value of our home by X amount of money. So it's
Yeah.
worth it. It's an investment type of thing there.
Which, by the way, like, the reason we bring this up, the reason I bring this up with clients and dentists, is just accept that not every single investment in your life has to make sense on the balance sheet.
Yeah.
Just accept it.
Yeah.
So I think
You can just buy a pool. If you want
just buy a pool.
just buy the pool. It doesn't
And-
need to have some financially positive outcome.
By
for
the
you.
way, I think pools are one of the greatest lifestyle investments you can make. I really
you
do.
go.
I've yet to ever talk to anyone who doesn't love a pool, or who regretted putting a pool in. But it doesn't mean it's a good financial move. It's
Yep.
not a good financial move. Just accept it. That's okay.
I love that point. Okay, let's do our third here. My third principle is do not stop saving. So we generally recommend that, again, the gold standard for saving should be about 15 to 20% of your gross income. I would be very hesitant to lower that savings rate percentage because you are getting into a new house. Ideally, you want to keep it the same that you've been doing there and work towards that. Again, this goes back to what we've been talking about. If your home is typically not an investment, right? You are not cashing that out to fund financial goals. It's an asset that can be passed on to your kids, yada, yada. And so if you're lowering your savings rate to accommodate a newer, nicer house, you're just hurting yourself in the long run financially there.
Yep.
I don't know if there's much else to add to that, Matt. Do you have anything?
No, I mean, I just think the last two here, I think really all three, is just be careful being house poor.
Yeah.
Right? Like, if you don't check some of these boxes, that excitement you feel with anyone that everyone feels when they buy a new home, that excitement can quickly turn to stress and anxiety if you're not planning ahead and actually looking at the numbers and you're not actually organized around these numbers. Yeah, I think on the savings one, let's say if you're within that range of 15 to 20%. So you've been saving 20 and you're like, okay, we figured all the numbers, we got the down payment, we got the mortgage, whatever, we got it figured out. Our savings going to go down to 16%. Like, I think that's okay. I think, that's a totally fair trade-off there. It's where we're saving 20%. Now we're going to go buy this monstrosity and we're only saving 4% or no money at all. Like, there's a wide range there. So if you keep it within that 15 to 20% range, even if it drops a little, I think you're going to be okay.
And knowing your long-term numbers comes into play here, right? Where we talked about Coast Fire the other day, or some people can reduce their savings. Maybe you are at a point mid-career where you've done some heavy lifting and have some good savings built up, where you can say, okay, I don't need to do 20% anymore. I can go down to maybe like 12 or 11% because of this new house. And that's okay because your assets are still growing and things there. So yes, just be conscious of that. Know your long-term numbers, know your current numbers. House is not an asset, so you still need to make sure you're putting money in other assets while you have the home.
Yeah, love it. I think the last part here, Jake, we wanted to talk about just kind of big picture trade-offs. I love this topic because I think we try to encourage this mindset of like the trade-off mindset versus like black and white solutions mindset. Everything when it comes to money, really everything is just simply a discussion around trade-offs. So we wanted to hit what are these kind of big trade-offs for people to consider when it comes to buying a home.
So I'll get personal here for a second, slightly personal. I've just been thinking about this a lot recently. So I bought a home. For people who are trying to buy a home now and struggling, don't listen to the next 10 seconds of this. I have a 2.99% rate on my home.
Yeah, everyone hates you right now. All the younger listeners hate you right now.
I want to make sure that people know this is not because I'm smart or a genius or anything. It just was lucky, stupid timing that I got this 2.99% rate on my home.
We have an inside joke here. Can we tell really quick?
Yeah, let's talk
about it. Can we tell really quick?
Yeah.
A story we hold fondly here in DA, the hallways of DA. It was especially Will and I. So several years ago, whenever you bought this home, it was years ago, we get a message.
Now,
21, yeah. So 5 years ago, we get a message from Jake, both Will and I. And Jake's like, man, can we talk? We need to chat really quick. You hop on. And so we all get on together. And Jake was stressing. Understandably so.
Very much so.
Well, it's very understandably. Anyone who's ever bought a home knows the stress. It's a big purchase. But your specific stress was around the details of the rate and the terms and all this stuff. And I believe, I don't know the exact numbers, but it was some. Oh, you do? Okay, shares the numbers.
So I'm an optimizer. So during this time, again, people who are trying to buy a house now are going to roll their eyes so hard at this, which you should. The rates are like fluctuating between like 2.75 and 2.9, 2.95% at this point. Yeah. And I was stressed because there were 2.75% rates, but I could not get those. And I was bumping up to 2.99%. And I was losing my mind. A financial optimizer like, oh my gosh, do I need to wait? Can we get back to 2.7? Is 2.9 even good? Can I even afford the house at 2.9? What's going to happen? And now looking back, that is the most ridiculous conversation. Which is great. This is value of financial advisor. Matt and Will were my financial advisor. And I was like, am I being dumb or am I being not dumb? And they're like, you are for sure being dumb here.
I think we were nicer than that.
Yes, but it was amazing.
Were just like, dude, buy the house. Like, does it fit with your life? Like, buy the house.
Yes. So hopefully people get a good chuckle out of that. So anyway, fast forward to today. And I've thought about, this is everyone like, okay, do we upgrade lifestyle, moving homes? When does that happen? I've just thought a lot recently about, I have a 2.99% rate on my mortgage, which is awesome. My monthly payment is very reasonable for where my income level and things are at. Getting into a new home would be a step up, which I think there's a lot of people in my situation too, with good rates, old homes. Like if we do a new house, better home, it's going to cost us a few $1,000s more a month to upgrade and get into a better home, even with the equity that we built up. And I've just been thinking recently, Matt, about, okay, let's say just, again, throwing numbers out there, like your home is $3,000 more per month, right? To kind of upgrade and get the nicer home that you want. $3,000 a month is not nothing.
Yeah.
And if you just I just think of this in the context of, okay, well, what could I do with that $3,000 a month? Could I buy a country club membership? Could we go on more family vacations? Could we buy more trees for the yard? Could we upgrade our current house or get new carpet or there's so much, like $3,000 a month, $36,000 a year is a big chunk of change that this is where what's the trade-off here? Could we actually live a better lifestyle, do more of the fun things that we want? or should we just sink this money into a home? Which again, this is like trade-offs. If you just want to have the nicest, biggest home, that's great. That's worth it to you. But I just find this fascinating because homes are expensive and it's usually the biggest expense that you have every single month. It's like the one lever you can pull if like, okay, well, like a cheaper house versus a more expensive house can determine a lot of how you want to live lifestyle-wise.
Yeah.
So I just think it's an interesting conversation.
I'm glad you brought this up. Honestly, first of all, I'm glad you told your personal story. I really do, because I think people can relate to that. We've all kind of felt these feelings. And I'm glad you brought this up because I don't know if enough people actually think like this. I don't think enough dentists actually think, because I think what most dentists do is they understand this in theory. They're like, oh yeah, totally. Like I understand the idea, like if I buy this home, I'm not going to be able to travel as much. They understand that in theory, thinking I'm going to be disciplined in the future and not travel as much because I really want this home. Right. But how many dentists out there actually that we know are actually living those trade-offs as opposed to just talking? Like, I think most people nowadays are going to justify the home purchase and still take the vacations and not really change their lifestyle.
Which if you do that, that's awesome. Right.
As long as you actually can save for the future.
Yes. If we're checking out your boxes, we're saving on pace for retirement, all those things. If you can do it all, great. Please do it all. Get the nice home, go on a million vacations. That's great. But I think for most of us, even the clients that we work with, money is a finite resource and there's trade-offs for different things. And it's like, okay, you can get this newer, nicer home, but maybe that's limiting some flexibility to do other things. Or maybe that's preventing you from cutting back a day at the office, right? Where it's like, maybe like that is like, you might have to stay working your 4 or 5 days a little bit longer because we're getting to this home. Is that okay with you? Like, is this new house worth it? Every day being in worth it for that trade-off. And so homes are expensive. This is like the same car question too, is like, if you want to buy a nice new home and spend a lot on it, please do. That's fantastic. But there's the other way of like, well, maybe I don't need that and we can stay in our current home and I have less stress and maybe we can do more fun things that I'm wanting, or I can take more time off work. And so I would always think about that whenever upgrading or remodeling or doing anything with the home. Pretty big trade-off there to consider. Yeah.
And I think there's an important thing to note here as well, because what we hear a lot from people is, and I've joked about it in the past, is, and this is all related. A lot of times we hear in the past from dentists of like, oh, I'm doing this for the kids, right? Like Jake, how many times have you heard that?
A lot of times. It's
I'm
a
doing
good
this for the kids. It is a good thought. But here's a pushback thought. Because if you counterbalance this is backed by data. I don't have it in front of me, but I've read this a few times and I've heard this multiple times on different podcasts. The number one fear of parents outside of the safety and health of their kids, that's obvious. Outside of health and safety of their children, the number one fear is entitlement, is their kids being entitled. This is like backed by a lot of data.
That's true. Sure.
Yeah. Every parent out there is going to say, I would imagine if they're listening to this, they're like, yeah, I don't want my kids to be entitled or spoiled.
Yeah.
So think about this. I'm doing it for the kids, but I fear my kids being entitled.
Mm-hmm.
Your luxury becomes their baseline. So when you're 45 or whatever years old, 50 years old, and you're like, I'm going to go buy this we're not saying don't do it. I'm just saying, think about the idea of like, I'm doing this for the kids. You buy this mansion. That becomes this incredible luxury for you and your spouse and partner. And I've heard this before in the past, like the money story people have around, like they didn't grow up with much and they were poor and they couldn't, whatever. They never wanted to hang out of their house. They're embarrassed. Totally get all that. So you want to go like, this is kind of like satisfying that old wound you had from back in the day. But again, you've got to think about the impact you're having on your children. And if you're doing this for the kids, think about the fact that, again, you are now establishing a new baseline for your children of what they expect in life and what they're going to have to do moving forward. You're creating a pretty long road for them to get there. Just food for thought. Jake, what are your thoughts on that? Is that a crazy stretch?
No, I don't. I think that's great. I want to share. Taylor won't mind us sharing this. I've talked to him before. He might have even shared it on the podcast. There's a smaller example of this. He got a new car recently, like a new van for his family. And his funny story is he brought it home, this new van, and one of his daughters actually started crying because she missed the old van. Taylor was so stoked, like this awesome, cool new van for the family. Look at all these gears. There's a TV, yada, yada. And his daughter was like, where's our old car? I missed the old car. She had no idea or didn't even want the upgrade.
Yep.
And so I think that happens a lot with kids is they actually want or expect a lot less than we think.
Yep. And they don't care as much as we think.
And they don't care as much
at least about
think.
The material things. They care about time and attention from you as a parent. They don't care as much about the material
But
things
this
like,
leads
as much as
back.
we do.
Yes, this leads back to really it's just be intentional with the house purchase. We say this with all financial decisions. Just think about it for maybe a day more or a half a second more, and just consider some of these trade-offs. And if you want a nice new home, buy it. But consider like, how is this impacting retirement? How is this impacting future spending? My stress levels, my workload is like, consider all those things rather than just be like, well, it's kind of, we've been in our house for 6 or 7 years. My neighbors are all getting new homes. It's time to upgrade. It's like, this is just the next step in the things that I'm supposed to be doing. We always just recommend interrogate what you think you're supposed to be doing, right? Like that's the thing. Whatever society tells you or friends will tell you, do it for you and for the things you want, not for any outside reason.
Yeah. I think that's a great takeaway message. We're not saying don't go buy the home. We're not saying don't go upgrade the home. We're not saying don't go remodel the home.
Yeah.
Just be, I like the word you used, intentional, thoughtful, curious about what's driving these decisions, and be honest about the trade-offs you're making when you're making these decisions. So I think it's great,
Yes,
Jake. Anything else you want to add to any of this? Any other words of wisdom? It's a great topic.
I guess we didn't mention quick for the people who don't know, maybe young dentists who are still listening to this. If you're buying into a practice, it's a big like homeowner thing to take note of. When you're buying into a practice, banks really don't like business income for the first little bit. They love W-2 income, which is crazy and it's weird. Usually if you're buying a practice, banks will not lend to you for at least a year, typically. For a house. So it's like if you're moving somewhere, buying the practice, like, oh, I'm ready to buy into a house too. You might have to wait a year, sometimes even like a year and a half to 2 years, depending on the lender. That's just a note that I have for a lot of dentists who are kind of confused or they get shocked by that. Like, I bought this practice, I'm ready to buy a house now. We've been waiting 3 years already before we bought the practice, and now we have to wait another year, 2 years, and that can cause some stress and maybe marital problems or different things there. Just know that it takes some planning. Or maybe if you have an LOI already in place or purchase agreement, something there, maybe you can get the home in the area. Anyway, just something of note that we didn't bring up for, I think is important.
That's a whole other discussion. I think it's really good because that's a discussion we have a lot with dentists of home versus practice. And there's a lot of nuance there of which one you should do first. So, but I think generally to your point, generally buying the home first is going to hurt you less than buying the practice first.
Yes.
When it comes to hindering future lending options.
Yeah, I don't think anything else. So to recap, just quickly, if you're thinking, okay, we want to buy a new home, what rules do I need to follow? Look at 25% or less of your gross income as your monthly payment.
Before taxes.
That's gross is before taxes. We're giving you actually some more room there rather than net. Don't use all of your cash for a down payment. Do not exhaust your entire emergency fund and try to maintain your savings rate. Again, we recommend 15 to 20%. Those would be like the 3 boxes you can look at checking and just considering what can I afford? What can I do? If you do all 3 of those, you're actually going to be in pretty good shape, I think.
Yeah, I think that's great. Great topic, Jake. Really appreciate the thoughts and the wisdom. If you're out there listening, I think the critical piece here, as we've highlighted, is just how important it is to have someone in your corner, honestly, walking you through this, understanding the nuances, helping you. Like we can't even tell you how many times we've had dentists just think or just say and really feel like, holy cow, having someone in my corner that knows my numbers, that knows the things that I've said are important, can hold me accountable to what I'm saying and to my goals, is massive, so critical to getting to a place of making work optional on your timeline. So if you're out there listening and you're like, I need help with this stuff, we are here. dentistadvisors.com. Click on the book free consultation button. We'd love to talk to you and see how we can help you with either future home purchases or really anything else going on in your financial life. And then, of course, we have the Dentist Money Summit coming up, dentistmoneysummit.com, June 11th through the 13th. We'd love to have you there. With like-minded dentists there in Midway, Utah, it's going to be a great time. So for now, Jake, thanks for being here and sharing your words of wisdom. Everyone, thanks for listening. Till next time, take care. Bye-bye.